Today we examine the mortgage industry omnishambles, and it's more than just a flesh wound. Welcome to the Property Imperative Weekly to the 17th of March 2018. Hello again. I'm Martin North, Principal Analyst at Digital Finance Analytics. In this week's review of property and finance news, we start with the latest January data from the ABS, which shows that lending for secured housing rose 0.14% or 28.8 million to 21.1 billion. Secured alterations fell 1%, down 3.9 million to 391 million, and fixed personal loans fell 0.1%, whilst revolving loans fell 0.06%. Investment lending for construction dwellings for rent rose 0.68% or $10 million to 1.2 billion. Investment lending for purchases by individuals fell 1.34%, down 127 million to 9.4 billion, whilst investment lending for others rose 7.7%, up 87 million to 1.2 billion. Fixed commercial lending, other than for property investment, rose 1.25% or 260 million to 21.1 billion, whilst revolving commercial lending rose 2.5% or 250 million to 10.2 billion. The proportion of lending for commercial purposes, other than for investment housing, was 45% of all commercial lending, up from 44.5% last month. The proportion of lending for property investment purposes, compared with all lending, fell 0.1% to 16.6%. So, what we're seeing is a rotation, if a small one, towards commercial lending for more productive purposes. However, lending for property and for investment purposes remains quite strong. No reason then to reduce lending underwriting standards at this stage, or to look to weaken other controls. But this also explains the deep rate cuts the banks are now offering, even to investors. ANZ Bank and the National Australia Bank were the last of the big four to announce cuts to their fixed rates, following similar announcements from the CBA and Westpac. NAB has dropped its 5-year fixed rate for owner-occupied principal and interest home loans by 50 basis points, from 4.59% to 4.09%. The bank has also reduced its fixed rates on investor loans by up to 35 basis points, with rates starting from 4.09%. And last week, ANZ also dropped fixed rates on its interest and advance interest-only home loans by up to 40 basis points, with rates starting from 4.11%. And further, fixed rates on its owner-occupied principal and interest home loans have also fallen by 10 basis points, with rates now starting from 3.99%. This fixed rate war shows our big banks are not pricing in a rate hike anytime soon. But we think those offers will likely encourage churn amongst existing borrowers rather than bringing new buyers to the market. For example, the ABS housing finance data showed that in original terms the number of first home buyer commitments as a percentage of the total occupied housing finance commitments rose to 18% in January 2018 from 17.9% in December 2017. And of course this got all the headlines from the real estate sector, but the absolute number of first-time buyers fell, thanks mainly to falls of 22.3% in New South Wales and 13.3% in Victoria, both areas where there have been first-time buyer incentive schemes in place. More broadly, there were small rises in refinancing and investment loans for entities other than individuals. The latest data from CoreLogic shows home prices fell again this week, with Sydney down for the 27th consecutive week, and their index registered another 0.09% drop, whilst auction volumes were also down last week. And to reinforce the slowing momentum in home prices, this graphic, which Arthur sent me, thanks Arthur, shows further falls in prices. So momentum is definitely slowing. CoreLogic also said that auction volumes were down last week, and in the last week the combined capital city final auction clearance rate fell to 63.3% across a lower volume of auctions, with 1,764 held, down from 3,026 the prior week. And then there was a slightly higher rate of 63.6% clearance. The weighted average clearance rate has continued to track lower than the results from last year. Comparing the corresponding week, it was 75.1% last year. But the strategic issues this week relate to the findings from the Royal Commission and from the ACCC on mortgage pricing. I did a separate video on the key findings, but overall it was clear that there are significant procedural, ethical and even legal issues being raised by the Commission. And despite their relatively narrow field of view, thanks to the terms of reference, they cannot comment on bank regulation or macro-prudential, but the inquiry's approach is to examine a series of case studies from the various submissions they've received, and then apply forensic analysis to dig into the root causes, examining misconduct. The question is, of course, do the specific examples speak to wider structural questions as we move from the specific instances? And we discussed this on ABC Radio this week. From NAB, we heard about referrers providing leads to the bank outside normal lending practices and processes, and some receiving large commissions despite not being in the ambit of the responsible lending code. From CBA, we heard that the bank was aware of the conflict brokers have, especially when recommending an interest-only loan, because the trail commission will be higher as the principal amount is not repaid. And from Aussie, we heard about their reliance on lenders to trap fraud, as their own internal processes were not adequate. And we also heard of examples of individual borrowers receiving loans thanks to poor conduct or even fraud. And we also heard about how income and expenses are sometimes misrepresented. So the question is, do these various practices show up more widely? And what does this say about liar loans and mortgage systemic risk? We've always struggled to match the data from our independent household surveys with regard to loans to income and loan to value, compared with loan portfolios we've looked at from the banks. But we think now we know why. In some cases, income is overstated, expenses are understated, and so loan serviceability is a potentially more significant issue than the banks believe, especially, of course, if interest rates rise. In fact, we saw very similar behaviours in the finance industry in the US before the GFC, suggesting again we may see the same outcomes here. One other point, every lender is now on notice that they need to look at their current processes and backbook to test affordability, serviceability and risk. This is a big deal. We will also be interested to see if the Commission turns to look at foreclosure activity, because this is the other sleeper. Mortgage delinquency in Australia appears very low, but we suspect this is associated with heavy-handed forced sales, something again which was apparent around the GFC. More specifically, as we said in a recent blog, the role and remuneration models for brokers are set for a significant shakedown. Turning to the ACCC report on mortgage pricing, this was also damning. Back in June 2017, the banks indicated that rate increases were primarily due to APRA's regulatory requirements. But now, under further scrutiny, they admitted that other factors contributed to the decision, including profitability. So last December, the ACCC was called on by the House of Representatives Standing Committee on Economics to examine the bank's decisions to increase rates for existing customers, despite APRA's speed limit only targeting new borrowers. The investigation falls under the ACCC's present inquiry into residential mortgage products, which was first established to monitor price decisions following the introduction of the bank levy. But here are the main points from the ACCC report. Firstly, banks raise rates to reach internal performance targets because concern about a shortfall relative to performance targets was a key factor in the rate hikes, which were applied across the board. And even small increases can have a significant impact on revenue, the report found. And the majority of existing borrowers would likely not be aware of small changes in rates and would therefore be unlikely to switch. Secondly, a shared interest in avoiding disruption. Instead of trying to increase market share by offering the lowest interest rates, the big four banks were mainly preoccupied and concerned with each other when making pricing decisions. It shows a failure in competition, in my view. Thirdly, reputation is everything. The banks, it seems, were very conscious of how they should explain changes. As it happens, blaming the regulators provided a nice alibi. Fourthly, for profit, internal memos also spoke of the margin enhancement equating to millions of dollars, which flowed from lifting investment loans. And lastly, new loans are cheaper, legacy rates are not. Banks, of course, are offering deep discounts to attract new customers funded by the back book repricing. The same, by the way, is true for deposits too. Now, the Australian Bankers Association silver lining statement on the report said that they welcomed the interim report into residential mortgages, which they said clearly shows very high levels of discounting in the Australian home loan market. It's clear, they said, that competition is delivering better deals for customers. Shopping around works, and Australians should continue to do so to get the best discounts on the advertised rate. But they really are missing the point. We'll see if the final ACCC report changes, but if not, these are damning but not surprising, and again it shows the pricing power of the major lenders. So to the question of future rate rises. The Fed meets this week, and the expectation is they will lift rates again, especially as the Trump tax cuts are inflationary at a time when the US economy is already firing. In a recent report, Fitch Ratings said that central banks are becoming less cautious about normalizing monetary policy in the face of strong growth and diminishing spare capacity. They expect the Fed to raise rates no less than 7 times before the end of next year. And while still sounding tentative, the European Central Bank, they say, is clearly laying firm groundwork for phasing out quantitative easing completely later in this year. And they also expect the Bank of England to raise rates by at least 25 basis points this year. Now, Guy Debelle, RBA Deputy Governor, spoke on risk and return in a low-rate environment. He explored the consequences of low rates on asset prices and asks what happens when rates rise. He suggested that we need to be alert for the effect the rise in interest rate structures will have on the financial market and the way it functions, and that investors, he says, were potentially too complacent. There are large institutional positions that are predicated on a continuation of the low volatility regime remaining in place. He said that he'd expected that volatility would move higher structurally in the past, and this has turned out to be wrong. But now he thinks there is a higher probability of being proven correct this time. In other words, rising rates will reduce asset prices, and the question is, have investors and other holders of assets, including property, been lulled into a false sense of security? All the indicators are that rates will rise, and you can watch our blog on this. Rising rates, of course, are bad news for households with large mortgages, exacerbated by the possibility of weaker ability to service loans thanks to fraud and poor lending practice. We discussed this, especially in the context of interest-only loans and the problem of loan resets on the ABC 7:30 programme on Monday. We expect mortgage stress to continue to rise. There were more discussions this week on housing affordability. The conversation ran a piece showing that zoning is not the cause of poor affordability, and neither is supply of property. Indeed, planning reform, they say, is not a housing affordability strategy. Australia, they say, needs a more realistic assessment of the housing problem. We can clearly generate significant dwelling approvals and dwellings in the right economic circumstances, yet there is little evidence this new supply improves affordability for lower income households, they said. 3 years ago, after the peak of the Western Australian housing boom, these households are no better off in terms of affordability. In part, this may reflect that significant numbers of new homes appeared not to house anybody at all, and they cite a recent CBA report that estimated that 17% of dwellings built in the 4 years to 2016 remained unoccupied. They say if we're serious about delivering greater affordability for low-income households, then policy needs to deliver housing supply directly to such households. And this will include more affordable supply in the private rental sector, ideally through investment driven by large institutions such as super funds. And for those who cannot afford to rent in this sector, investment in community housing is needed. In capital city markets, new housing built for sale to either home buyers or landlords is simply not going to deliver affordable housing options unless a portion is reserved for those on low or moderate incomes. But, and it's a big but, they did not discuss the elephant in the room, booming credit. We discussed the relative strength of different drivers associated with home price rises in a separate and well-visited blog post, popping the housing affordability myth. But in summary, the truth is banks have pretty unlimited capacity to create more loans from thin air, fiat, let it be. It is not linked to deposits as claimed in classic economic theory. The only limit on the amount of credit is people's ability to service the loans eventually. With that in mind, we built a scenario model based on our core market model, which allows us to test the relationship between home prices and a series of drivers, including population, migration, planning restrictions, the cash rate, income, tax incentives, and credit. And we found the greatest of these is credit policy, which has for years allowed banks to magic money from thin air to lend to borrowers to drive up home prices, to inflate the bank's balance sheet, to lend more to drive prices higher, repeat ad nauseum. Totally unproductive. And in fact, it sucks the air out of the real economy and money directly out of punters' wages, but makes bankers and their shareholders richer. One final point, the GDP calculation we use in Australia is flattered by housing growth, triggered by credit growth. The second driver of GDP growth is population growth. But in real terms, neither of these are really creating true economic growth. So to solve the property equation and the economic future of the country, we have to address credit. But then again, I refer to the fact that most economists still think credit is unimportant in macroeconomic terms. The alternative is to continue to let credit grow well above wages and lift the already heavy debt burden even higher. Current settings are doing just that, as more households have come to believe the only way is to borrow ever more. But that is ultimately unsustainable, and this is why there will be an economic correction in Australia, and quite soon. At that point, the poor mortgage underwriting chickens will come home to roost. Next time, we'll discuss in more detail how these scenarios are likely to play out, but already we know enough to show it will not end well. If you found this useful, please do like the post and add a comment or a question. I read them all. And if you've already subscribed, thank you. I'm really grateful for your support. And if you are not yet a subscriber, please do subscribe to receive future alerts. And by the way, I've held over my posts on cybercurrencies and the latest Household Financial Confidence Index because of the Royal Commission this week. But I will get to them in due course. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for taking the time to watch.